Santelli's in Chicago this morning. He's standing by at the CME. Rick, the numbers, sir.
Yes, these are March reads on the Consumer Price Index, coming in under minus 1/10 on headline, minus 1/10. We're expecting the exact opposite. We were expecting up 1/10, minus 1/10. Well, we equal where we were in May of 2020 to find a lower number. You're all the way to April of 2020, the heavy COVID-affected months of the calendar. If we take food and energy out, still coming in on the under, up 1/10. We're expecting triple that number, up 1/10. Well, that would equal where we were in June of last year. To find a lower number would be 0 in January of 21. These are definitely low numbers. Now, let's look at year-over-year perspective, shall we? Up 2.4, we're expecting 2.6. 2.4 would equal where we were in SEPA 24. You have to go to Feb of 21 to find a lower number. Now let's go year over year. Ex food and energy, expecting 3, comes in light 2.8. That follows 3.1. 2.8 would be lowest since March of 21. These are really low numbers. Now let's look at initial and continuing claims, shall we? On the initial claims, we're looking for a number that would be roughly in the 224 camp, comes in at 223, very close to expectations. And if we look at the continuing claims, last month they reached 1.903 million, and once again they revised it away. 1,893,000 is last month, and the new number 1,850,000. That really is a nice drop. And if we want to comp the last time we were at that level, well, it would be the last week of January when we were under 1.84. So that would be your comp. You could see yields haven't moved under in a dramatic way, but I will say there's a bit of irony here considering all the tariff stories on inflation. To see these numbers coming in light for March, well, it's somewhat enlightening. Now, let's go to Steve Leisman for some thoughts as he peruses some of these data points. Steve?
Yeah, Rick, thanks. I'm looking at here this core goods number, which the Fed had flagged as something that they were worried about, which was perhaps a pop that you saw in prior months because of front running on tariffs. That came back and was well behaved. If you look at the commodities, ex-food and energy core goods, it resumed a negative downward move. Nice help on vehicle insurance was down 0.8%, at least on the month. It's up quite a bit. And you did not get, you went the other way on the owner's equivalent rent, 0.4, not as bad as it had been. You had some pop up in food prices, 1%, 1.3%, and you got an awful lot of help from energy this time around. The key here is going to be, well, this may be the calm before the storm, a lot like the employment numbers. Do you have higher inflation numbers coming through because of some of the tariffs that are out there? Real quickly on the tariffs, the market seems to think it got a lot of relief, and maybe it did. Maybe there's a change in stance of President Trump. But I'm reading a lot of the dismal scientists that say, you know what? There might have been a lot less there than you think. Average tariffs in the country are still very high, even after that relief, much higher than 10%. Wells Fargo just sent me a note. They say the average tariff in America is 27%. I'm seeing numbers 23, 22, and they're still predicting negative numbers on GDP and surges in inflation from the existing tariffs, unless they go away, Andrew, from negotiation. To you, Andrew.